Welcome back, everybody. Today we are diving into the stock Illinois 2 Works, ticker symbol ITW, and over the last year they are down 15%, so quite the pullback. They are a $65 billion market cap, so they're pretty big, I would say, and they're in the industrial sector. Their forward PE is 23. That's pretty reasonable. I don't think that's too far aligned, especially with a dividend yield of 2.33. This is a pretty safe stock, I feel like. And over the last 5 years, they are up 50%. So again, pretty good performance, nothing crazy. And then in the last 10 years, 280%. I think that's right on par with S&P 500. And then their dividend, I want to circle back and highlight. So over the last 5 years, they have a 14% CAGR on the dividend, which is really good. We like to see definitely double digit. It's just a compounding machine with that. And then their annual payout is $4.88. So for every share, you get about $5 of dividend income, which we like to see. And then, yeah, they've been paying their dividend for 26 years, which is really, really good. That makes them a dividend aristocrat. And then we just love to see that consistency. We love through the recessions and hard times that companies are still able to pay their dividend. So let's just dive right into the business. So they Illinois 2 Works has a lot of different company like segments. So they have automotive OEM, construction products, food equipment, polymers and fluids, specialty products, test and measurement, and electronics, and then welding. And as you can see, there's not one sector or segment that like dominates their revenue. They're all pretty consistent between like 19, 16, 13% of their annual revenue. And then last year they did 14.5 billion in revenue. So they are a pretty big company. And so I would kind of want to dive into these company segments. So the first one is automotive OEM. And OEM stands for Original Equipment Manufacturer. So they make stuff like fasteners, interiors, and exterior components, and then stuff for like the engine, like powertrain. And they have a couple brands with them. This is just, their biggest clients and customers are like Ford and GM and stuff. And then it's just a pretty reliable business. I mean, cars aren't going anywhere. And then part of their construction business is Alpine. So they make stuff like connector plates for all these trusses and stuff. And then one of the equipments, they have this Alpine linear saw. So just another heavy machinery just for lumber. And this is a big part of their construction business. And then the next part is food equipment. So they make stuff like dishwashers, refrigeration, ovens, and then like oven racks. And then a big brand that they have is Baxter. And they make commercial ovens. It's all like industrial commercial kitchens that use this. They have like oven racks, and then just other stuff like, look at this water meter. Yeah, just for the industrial kitchen. You don't really see this, I guess, that much unless you work at a restaurant. But in the back, I'm sure they have an Illinois 2 Work product. And then the next one is polymer and fluids. They have stuff like engineered adhesive, sealants, coatings, lubricants, additives, automotive wiper blades, and cleansers. They have a couple. I think Defcon is a pretty popular brand. This is just another part of their business. And then specialty products. So this is more of a consumer-facing like segment. So like the 6-pack rings that you get with like a Gatorade, Illinois Tool Works makes, and then just specific like Ziploc bags or in resealable bags that companies like Pepsi, Coca-Cola, all like buy from. And it's just this like consumer packaging isn't going to go anywhere soon. So I feel like this is a good business segment. And then the next one is test, measurements, and electronics. This one I'm not as familiar with, but they have stuff like Avery Weightronics, which is just like they have like a bunch of scales. They have stuff for like logistics and package weighing. They have rail scales. It's just I can see it down here, just a way to weigh stuff. I'm not too familiar with this line, but another thing that I'm sure you've heard of is their welding brand Miller. Miller's a really popular brand. I see almost any welding like rig that I see is Miller, and as you can see, I mean, they're a really popular brand. This is actually their smallest segment, which surprised me because this is like the most popular brand I feel like that they have. But yeah, they just have like welding equipment, welding face shields, and all that. And then, so now that you get an idea of their business segments, let's dive into their financials. So this is their revenue over the last 5 years. It is, I mean, pretty consistent. You see a pretty big dip here with the lockdowns. I'm not too concerned about that. They bounce back, seems like right away. But and then on this quarterly, there's nice consistency. We like to see that. I mean, you'd like to see more growth, honestly, but um, yeah, steadiness is, I mean, you can't really go wrong with nice steady business. And then the earnings per share, we also love to look at. So the earnings per share is, this is what I like. It's very consistent. It's continued to go up. It's kind of flattened off in the last 5 years, but over time, I feel like it will continue to go up. And the consistency is key here. You like to see a company be consistent. They don't have these big swings. I mean, they do sometimes, but and then another thing that we love to see is their shares outstanding. They are buying tons of shares throughout the years. I mean, look, they're buying about 3% in the last quarter, or in the last 12 months. They bought about 1.5% of the shares outstanding. Yeah, and then let's go to some of their price ratio. So their PE ratio, it's been consistently around 25 for the last, I mean, 5 years. It's hovered around there. And with the earnings per share, I mean, it's kind of flattened off. The price has kind of stayed the same, flattening off. But over time, it's continued to go up. And then free cash flow per share. So the one thing we love about free cash flow is you can do 5 things with free cash flow. You can invest back into the business, pay down debt, make acquisitions, pay a dividend, and then do share buybacks. You can do all of that with free cash flow. And free cash flow is cash from operations minus your capital expenditure. And so over the last 2 years, you have seen a decline in free cash flow. I think they've been spending more in capital expenditures, so that's going to affect free cash flow. But yeah, so you can see you're paying quite the premium, 33 times free cash flow. That's kind of high. You'd love to see the stock pull back a little bit and get closer maybe to this 20, 25 like price to free cash flow. Yeah, and then we can look at their balance sheet real quick. So they have about like 1.3 billion in cash and cash equivalents against, let's see, they have about 7 billion in long-term debt. Nothing crazy. You love to see them pay down this debt a little bit, but I'm not too concerned. They're 65 billion-dollar market cap, and they only have 7 billion in debt. That's not a concern at all. And then, so this is their earnings report, their latest earnings report. And I just kind of want to highlight some of the things that they reported. So you can see this top line growth. They went from 3.5 billion all the way up to 3.9 billion. But with inflation and like raw materials costs going up and transportation costs going up, these cost of revenues did increase from 2 billion all the way up to 2.3 billion. And then the selling general administrative did tick up a lot. As you can see, it's a really tight labor market. You have to pay people more to work for you. And then so operating income is essentially flat year over year. I mean, you love to see like operating income growth, but a small 1 year difference. I mean, it's not the end of the world that they didn't grow. And then you can see their net income basically flat year over year. You love to see them grow the bottom line, but again, it's not too concerned because we're more focused on dividends. And as you can see, the earnings per share was $2.12 this year compared to $2.12 last year. So, like I said, basically everything's flat year over year. And then, but their dividend did increase. So last year they paid $1.14, and this year they paid $1.22. And you can see the dividend is really safe. Their earnings were $2.11 this year, like this last quarter, and then they only paid out $1.22. So the dividend is really safe, and as you can see, they did buy back some shares. It went from 316 million all the way down to 312. So it's just another way to reward the shareholder and it's a good thing that they're not diluting you. And and another thing I want to highlight from the earnings report, so with a brand like Miller, a really popular brand, they can have more pricing power. So you can see in this welding segment, their operating margin is 30%, and that's the highest of any like of their segments. I feel like that's because you have a strong brand like Miller. You can charge more for those products, and people are willing to pay. And so off of $450 million of revenue, you were able to make 140, which is really good. I feel like 30% operating margin on an industrial is really good. And so that basically is the rundown of Illinois Two Works. I do not own this stock, but it is on my watch list. I would like to see this pull down closer to 180. I would say, like, and then you get a better yield on cost, and with their dividend yield or dividend growth being 14% in the last 5 years, I feel like this is a really good stock to pick up. And yeah, so make sure you guys like and subscribe, boost the algorithm, and I'll catch you in the next one. Peace.